This recording, we're going to continue on with the material that we covered in week 6, finishing off profitability and starting to look at other aspects of ratio analysis as well. So where we finished up in week 6 of the live webinar was we introduced the whole idea of looking at profitability relative to the capital that was employed in the business. So essentially looking at your return on capital, either looking at it for both shareholders and debt holders together, in which case we put profit before interest and tax, which is also known as operating profit over capital employed, or we look at it just from the shareholder's perspective, where we look at profit after tax, and we divide that by shareholder funds. And these answers you can put in multiply by 100 over 1. They will give your answer in percentages. So if we go back, for example, to Alexis, the example we're using in class, our profit before interest and tax is 243 and 47. So operating profit is also known as profit before interest and tax. So big decline year on year. And your capital employed will be your debt plus your equity. So here your 563 plus your 200 and your 534 plus your 300. So if we do the calculations there for ROCE for 2011, which is the first column in 2012, in 2011 the operating profit was 243. Come back up here. And your capital employed, just be careful, it is debt plus long-term debt plus equity. So in that case here, 200 plus 563. So you have 243 divided by 763. So your return there is about 31.8%. We just put that in percentages. You go to one decimal place is fine. However, for this year, 2012, our operating profit before interest and tax has fallen, but our debt has gone up, which means our capital employed has gone up, and equity has fallen slightly. So that's 447 over 834. So that's only down below 5%, or just above 5%, should I say, 5.6%. So again, that's a significant drop year on year, and certainly shareholders will not be happy with that. Right? The main driver of that is twofold. Your profitability has really fallen, 243 down to 47, and your capital has gone up. So if anything, you should have expected profit to go up further because you've invested in capital. But that doesn't seem to have happened here, and again, we need to investigate why. You can also do another variation, which is called return on shareholder funds. Now, this is also known as ROE, return on equity, because we're just looking at the shareholders or the equity portion of the business. So that would look at net profit, which if we go back here, your net profit is 165 and 11. And you will also look at just equity, 563 and 534. So 165 over 563, that is 29.3%. However, it's fallen significantly now because you have 11 over 534. So again, when you're doing your ratios, make sure to show the formula, or at least show the numbers of where it's coming from. Because if you just stick down any figure here, the examiner won't know where those are coming from. And if you make a mistake, you won't get any working marks. So 11 over 534, that is just over 2%. So a significant fall because, of course, the decline in profitability. So again, your shareholders really wouldn't be happy there. It probably is still bigger than what you would get as a return on putting money on deposit, but there would be other companies that would earn a better return on that as alternative investments. So again, it's important to see, is this a blip, i.e. a one-off decrease as they bring in new investments and get them bedded into the business, or is this indicative of a long-term trend? Very hard to judge here because we only have 2 years of accounts to do a trend analysis on. So that's your core profitability metrics. Note there is another important term that you might come across when you're reading certain financial statements called EBITDA, which is earnings before interest, tax, depreciation and amortization. So essentially earnings before interest and tax, that's your operating profit. But they also add back depreciation and amortization. The logic here, these are related to historic decisions and they're not cash flow related. So people, they use the financial statement to strip them out, and they use EBITDA as a kind of approximate to cash flow. Now, it's not cash flow, but it is quite important in real world finance that they use that as a measure of underlying profitability, EBITDA. And I will give you a link to one or two very interesting topical articles in the Financial Times, which are about EBITDA. So what's happening now is there's actually EBITDA with a C at the end. So earnings before interest, tax, depreciation, amortization, and coronavirus. So they're trying to adjust for these one-off events that they feel may not be reflective of the true underlying performance. What also you will see some of the big social media companies doing, or the high technology startups, the high growth ones, is they'll call it community adjusted EBITDA, where they make these subjective adjustments to EBITDA to give it an underlying figure. And there's big debates now in the accounting profession and the Accounting Standards Board around, do we need to standardize what EBITDA means? Because EBITDA is not a standard metric like operating profit, so you can have any adjustment you want to get to a figure that you need. So keep an eye out for that. I will send one or two useful links in the recap email as well, just you might be interested, because EBITDA is probably one of the most popular metrics that financial markets use in terms of underlying profitability. It's not without its limitations, but certainly be aware it is an important metric as well as the other core profitability totals in the statement of profit or loss. So the next aspect of performance we're looking at is efficiency. Now, there's a number of different efficiency ratios you can calculate. We're just focusing on what we call working capital management ratios. And when you do your corporate finance module, usually with LEAM, or you might have a new lecture this year, corporate financial management, you'll talk about working capital management. So this is managing the inventory, the debtors, and the payables of a business, i.e. the short-term investments that continuously cycle in a business. As you buy inventory, you sell it, you get money in. As you make sales, you sell on credit, you get the money back in, and you buy goods on credit as well. So what we're looking at is calculating debtor days, inventory days, and payable days. So these are three key ratios that give you an indication of how efficient the company is at managing its working capital. And when we bring the three of them together, that will give us something called the cash conversion cycle. Now let's explain this in a bit more detail. So inventory days, if you want to take it down, and we'll talk about it in more detail when we calculate in a second, that's on average how long inventory stays in the warehouse before it's sold. Right? So when you buy it, how long does it take before you sell it? You add to that how long it takes your customer to pay you. So for example here, we put some numbers on it. Take for example, it takes you 30 days from when you buy the goods to sell it. So your inventory days on average will be 30 days. When you sell it, on average then it takes the customer another 30 days to pay you. Right? So actually, by the time you buy it, until you get money in, is 60 days. It's waiting 30 days to sell the thing, and even when you sell it on credit. So that means you have to wait another 30 days to get the money in. So all told, when the goods come in, until you get paid in cash, you have a 60-day waiting period. Now that may be reduced by the fact that if you buy goods, you may be able to get credit from your suppliers. So if, for example, you can get 20 days credit from your suppliers, the overall cash conversion cycle would be 40 days. Right? So that's an important thing I think we might draw out just to give you an idea. So in day 0, for example, you get the goods in. Right? So you get goods in here. In day 20, you pay for the goods. So we call that your trade payable days. There are 20. That you're getting credit of 20 days from your suppliers. On day 30, so you've waited 30 days since you've bought the goods, you sell them. Sell goods. But you sell on credit. So your inventory days here are 30. I'll keep these over another one. And then if you go on, once you sell the goods, you wait another 30 days. We'll say day 60, and you get paid. You get paid from your customer. So what we're saying is your inventory days goes from when you get the goods to when you sell them, i.e. 30 days. Your trade receivable days here goes from when you sell the goods to when you get paid. So if you sell in cash, trade receivable days would be nil, but here it took 30 days to get in. So that means from when we get the goods to when we get paid, it's 60 days in total. But the benefit is, and that helps your cash flow is, if you don't have to pay for those goods up front, that delays this portion. So that's why we take away trade payable days. So in this example, what we call the working capital cycle otherwise known as the cash conversion cycle, working capital cycle, otherwise known as cash conversion, is 40 days. What that actually means is when you pay for goods, you have to wait 40 more days before you get money in. So money out here happens 40 days, and I'll put that in red. Bear with me and I will bring that up. Money out is 40 days before money in. And that's an important one because the longer that is, the more expensive it is. Because you're going to have to finance that through an overdraft, and it suggests you're less efficient overall. Now, every industry is different because different industries hold different amount of inventory. Different industries offer different trade credit, so you have to compare like with like. But that's the key thing about the working capital cycle is when do you pay for the goods and when do you get the money in? The bigger the difference between those, the more difficult it is and the more expensive it is because you're going to have to finance that through an overdraft, etc. Now, of course, there are going to be companies that may have a negative working capital cycle, which means they get money in before they pay money out. A good example of that would be a supermarket. Supermarket will have very low inventory days because the stock on hand is sold on the shelves very quickly, so that inventory days could be a couple of days. So that could be very small. Your trade receivable days, supermarkets don't really have trade receivables. Because they sell to the end consumer, all their transactions are done in cash at the till or they're paid by card and they get paid the next day. And likewise, because supermarkets have a very strong negotiating power, they will be able to take a lot of trade credit from their suppliers. So that could be 30, that could be 60 days. So the way it turns out then is you have to wait very little to get your money in, wait very little to sell the goods. So they could be very low, this could be very high, and you can actually have a negative working capital cycle, which means your customers pay you for the goods before you have to pay your supplier. And you actually get a free use of money for the time period. So that suggests very efficient working capital cycle. But again, every industry is different and you have to compare like with like. So understanding that working capital cycle is important, and you will see that again in corporate finance as well. So what we're going to start now is we're going to look at inventory days as a starting point. Inventory days, and we're going to calculate it for both 2011 and 2012. So if we go back to the formulas, inventory days is inventory over cost of sales times 365. Now there are variations of the formula. We'll stick with the one we're given here. So inventory 300 and 406. Cost of sales, if we go down, 1745 and 2272. So for 2011, it'll be here 300 over 1745. You multiply by 365 to get it in days. So think about it, 1745 is the full year's purchases, and you have 300 left on hand at the year end. So 300 as a portion of the full year would be about 17%, and to get that in days, you multiply by 365. So about 62.7 days. So what that means is your inventory stays for about 62 days, nearly over 2 months before it's sold on. So the higher here, the less efficient you are, the slower you are at selling inventory. In 2012, it is 406, inventory has gone up, but so has cost of sales. So you're looking at the movement relative to the movement in cost of sales. So let's have a look at this. 406 divided by 2272 times 365. So 65.2. So actually what's happened is they've been slightly more efficient. Less efficient because it's gone up. Apologies, I'm misreading it. 65.2 days, because this of course is 2012, this column here. So you are 3 days, roughly 2.5 to 3 days slower at selling goods. So it's marginally deteriorated in terms of efficiency, but not a huge difference. It takes you about 2 months on average to sell your inventory. Then we'll look at trade receivable days to see how much credit are you offering your customers, and on average, how long does it take them to pay you. So if we're looking here, it's trade debtors, otherwise known as trade receivables, over revenue times 365. So here, trade receivables, if we go back to the question, are 240 and 273, revenue 2240 and 2681. 240 over 2240 times 365, and then you have 273 over 2681 times 365. So ratios can be a bit repetitive, but you need to know the formulas because they may not be given in the day of the exam. So that is 39.1 days. So on average, last year, it took about 39 days for your customers to pay you. That is often called DSO, if you ever see it, days sales outstanding. The higher that is, the slower your customers are paying you. Right. Whereas here, this year, 273 divided by 2681, you're now taking 37.1. So actually, be careful to interpret, that is improved slightly. So you're getting paid 2 days quicker than before. So that's a marginal improvement. The quicker you get paid, the less expense it is because you don't have to borrow money for cash flow purposes. So that is, on average, how long it takes your customers to pay you. And here, trade payable days, this is also known as DPO, days purchases outstanding. And this is, if we go back to the formulas, trade payables over cost of sales times 365. So if we go back, our trade payables, they're in current liabilities, 261 and 354. There are figures there. And then our cost of sales, 1745 and 2272. So again, the ratio is looking at the relationship between one line item and another. That's what a ratio does. So for last year, it was 261 over 1745. And this year, it's gone up. Significant increase. It's now 354 over 2272 times 365. So not only are we interested that trade payables are gone up in euros, we want to know how much have they gone up relative to the increase in cost of sales. That's what the ratio tells us. So that will be 54.6 days. So what that means is, on average, you took about 55 days to pay your suppliers last year. In this year, on average, it took you 56.9 days. So it's taking you a small bit longer. Now, generally here, the higher the better. What that means is you're getting more credit from your suppliers, so you can pay later. But I want to put a little flag there is, if that gets very high, it would be a red flag. So if that was 100 days, 120 days, or big increases, it may suggest that you're not able to pay your suppliers, not that you have agreed with your suppliers that you can pay. So the thing when we were watching, for example, here with Alexis is they have a big increase in their overdraft. If that overdraft is reaching its limit, the only alternative is not to pay your suppliers, and what you would start to see is a big ramp up in trade payables. So watch for that in other tutorial and past exam questions and in your question pack, where you see increases in overdraft coupled with big jumps in trade payables. That would be a red flag that you may not be paying your trade payables because you cannot, not because you've negotiated better credit terms. But in high level terms, the lower the better for inventory days and trade receivable days, selling inventory quicker, getting paid quicker, and the higher for trade payable, i.e. getting better credit terms from your suppliers. Now, it's not always perfect because there's things to balance as well. For example, certain business you can't get that down to zero because you need to keep a certain amount of stock on hand to satisfy customer demand. Likewise, you may not be able to get that down to zero for trade receivables because you may have to offer credit if that's part and parcel of your industry. Because if you don't offer credit to customers, they will go elsewhere for their custom and you will lose to your competitors. So it's important to realize is you want to have it lower for these two and higher for here, but there are limits and there are things to balance because you don't want to go to the extremes. Right? So both of those focus in on working capital management, particularly under the efficiency ratio. And you'll cover that in much more detail in corporate finance as well. The next key area we're looking at is this thing called liquidity. And we said at the outset in the week 6 webinar, liquidity relates to the short-term cash position. So this is the ability of the company to pay its short-term debts as they fall due. Now, this is quite important, particularly for young companies and high growth companies, because you could be a profitable company, making profitable sales, but getting no cash in because you're offering credit to your customers and you're paying up front to your suppliers to get better prices. But if you don't get cash in, you could go bust because you may have no overdraft and you may not be able to pay your obligations. So it's an important thing. You might hear that phrase, cash is king. That is very important for businesses. You need cash flow. And no more so in the current environment with COVID, a lot of companies are in cash flow difficulties because their sales have plummeted given the restrictions. So we have two key ratios we look at here. The current ratio, which is easy to remember, current assets divided by current liabilities, or the quick ratio, which takes out stock or inventory. And I'll explain why we do that when we get to it. So for the first one, we're comparing short-term assets, current assets, to short-term liabilities. And we want to see how much assets do we have relative to the liabilities. Right, so we look at this as the current ratio. So the current ratio here, last year, if we look at it, was 544 divided by 291. 544 divided by 291. And that is 544 divided by 291. That is 1.87. 1.87, it's often presented is to 1. It's presented like a ratio like that. Or you could just say 1.87. That would be fine as well. What that says is last year is you had €1.87 of current assets for every €1 in current liabilities. Now the ideal is about 2:1. But it can vary by industry. But generally, if you're comparing them in AC220, a benchmark is about 2:1. Any lower than that, and you will have liquidity issues. This year, here, it's going to be 679 divided by 432. So both figures have gone up. So that will be about 1.57:1. So remember here, this actually means liquidity has deteriorated. You have less current assets available to cover your current liabilities. So what we would say here if we were looking for commentary is our liquidity position has deteriorated. And what a good student will do is they will explain why. Well, the main reason here is you have a big increase in your overdraft and you have a big increase in your trade payables. So the problem is the growth in your current liabilities is outstripping the growth in your current assets. So that leaves you in a difficult position. If your payables start looking for the money or the bank looking for their overdraft, you may not have enough assets here to pay them in the short term, which can create what we call a liquidity issue, right? Or you're stretched with cash flow and it can cause, we often call that a cash squeeze, where you need short-term cash and you can't get access to it. Now, the quick ratio, otherwise known as the asset test ratio, is a more severe test. It says you should ignore inventory on the logic that you wouldn't be able to turn inventory into cash flow quick enough if you needed to. So they say inventory is not a liquid enough asset. Liquid meaning you can turn it into cash as and when you need it. So the only difference in the quick ratio is you take off, it's 544 minus inventory. So minus the 300 last year divided by 291. And in this year, it's the 679. Take off inventory, which has gone up to 406. And it's still divided by the 432. And your ideal here is around 1:1, i.e. excluding inventory, having the same current assets to cover your current liabilities. Anything lower than that, and you would be concerned about liquidity. So that is 0.83 or 0.84:1, so lower than the ideal. And this year is 0.67:1. So again, we can see the liquidity position. Is that right? 679 minus 406 divided by 432. 0.63, sorry. 0.63. So we're saying liquidity again is deteriorated. And what that means is for every euro in current liabilities the company has, it is only 63 cents in short-term assets. So for example, if these were called in, i.e. wanted to be paid very soon, you wouldn't have enough money. All you have is trade receivables at 273. So you would be very tight in your cash flow. And that's a big concern because if the bank is nearing the overdraft limit, or your suppliers are getting annoyed because you cannot pay them, you could have a very tight cash squeeze quite quickly. Even though you might have good growth prospects in the future, and we can see here they may be able to continue to grow revenue, you may not be able to get there because you have a cash issue, liquidity. So liquidity is quite important for businesses. You can be profitable, but have short-term cash issues, as this company appears to have. All right. So that looks at our liquidity, and we said liquidity is deteriorating overall. The final one we're going to look in this recording is what's called gearing, otherwise often known as your capital structure ratios. And I know you will probably look at capital structure in your corporate finance module. I think it's still delivered in AF2, which looks at how the business is financed, the mix of debt and equity in a business. The more debt you have, the higher the gearing ratio and the higher the financial risk in a company. So what we look at here to calculate gearing is what percentage of debt is in the capital structure. So it's debt over debt plus equity. Now we only look at long-term debt here. We do not include the overdraft, as we see that as a short-term source of finance. There can be different variations of it, but generally we look at long-term debt and equity capital. So here, to calculate our gearing, we're going to look at the debt and equity for 2011, 200 for debt, 563 for equity. So that is going to be 200 divided by 200 plus 563. So what portion of the business is financed by debt? That portion is about 26.2%. So what we say there is about a quarter of that business is financed by debt. This year we've taken on more debt. Alexis has. It's gone up to 300. And our equity is really ballpark similar enough, 534. So 300 plus, divided by 300 plus 534. So the percentage of debt in the capital structure now is 35.9%, in and around 36%. So what you're saying here is your gearing ratio has increased. The main driver of that is you've taken on extra debt. Generally, anything below 50% would be seen as lowly geared and not a huge amount of financial risk. Now, again, that will vary if you are giving, or if you're given in a question, industry benchmarks, well, then you should use that as your comparison. But the general one is 50%. But I said, if you're given more information about the company and the industry, use that instead. So gearing has gone up, but it's still a significant amount of equity in the business that you wouldn't be overly concerned yet about the gearing or the capital structure position. Right? Now, what you might be interested in is when is this borrowings to be repaid? So it's not clear from here, even in the information below, when is that debt to be repaid? Because if that's to be repaid next year, you could have a big issue, because where are you going to find the money to actually repay it? So sometimes exam questions will tell you when the debt is to be repaid, and that will give you an idea, will we have any issue in terms of refinancing that debt? The other key ratio we look at here is interest cover. You can have a look at interest as a percentage of sales. We calculated some of those already in terms of expenses as a percentage of sales. But the other main one is interest cover. So this looks at the affordability of interest based on current profitability. The top line is profit before interest, which would be profit before interest and tax, because of course that comes above the tax line. So that is operating profit. So just it leaves out tax there, but it is before tax as well, over interest expense. So here it will be the operating profit, the 243, over interest of 18, and then it will be 47 over 32 in 2012, because your profit has gone down, but your interest payable has gone up. And we have said earlier, the main reason that the interest payable has gone up is we have increased debt, more debt in long term, and in more of an overdraft, which you would pay interest on. So interest cover, this looks at the sustainability of the interest expense. Here it would be 243 operating profit over interest, and here it'll be 47 over 32. So 243 over 18 is 13.5, and the answer would there in times. What that means is your operating profit is 13.5 times bigger than your interest, meaning you have plenty of cover. Right? Even if your profit fell, you have enough to cover your payment of interest. Now, it doesn't look at capital repayments, i.e. repaying the actual loan amount. It just looks at the interest affordability. Whereas here, this year, your interest has gone up and your profitability has fallen. Your coverage is only 1.46 times. So that is a big deterioration. The lower this is, the riskier it is. In this case, in 2012, you only have one and roughly half times your interest as profits. So you can just about afford it. So again, what we're concerned about right throughout a lot of this is this decline in profitability temporary or is it a more longer term trend? We know this company has plowed in a lot of money into investments. We know they have raised in extra borrowings. So what we're probably going to look at now is to figure out, well, maybe it needs time to bed in. We don't know when these investments were made. Maybe they were made towards the end of the year, which means it'll take a bit longer for them to actually get it up and running and generate profitability. But certainly you would be concerned if that is the continuing level of profitability and if they don't get their cost management under control. So using 2 years will be difficult. You would like to see the budget for next year and you'd like to get an indication of what's happening. But certainly given the way the cash flows deteriorated, as we can see in the statement of cash flows, and we looked in the webinar, cash are gone down by 80 million. We'll need to get an indication of what's going on. Another piece of information happened here as well, if you can see. For example, look, there's a huge amount of extra staff been taken on. You're gone from 14,000 staff up to 18,500. So that suggests there has been big changes in this business with the new warehouse and new distribution center. So good students will be able to link that information here and bring it back into the question when you're analyzing the overall statements. So yes, it has been a poor performance in 2012, profitability wise, efficiency not too bad, liquidity was poor, and interest cover was certainly poor. But maybe there's an explanation that they're only starting to get up and running with this warehouse and distribution center. If that was only up and running in September, October, or towards the end of this year, the financial year, so you're told they expanded capacity during 2012, but we only have, for example here, we only have the accounts up to the end of March. So that means they only are really starting implementing this new warehouse when we get these accounts. So we need to really see the year end March 2013 to get a bit of flavour of what's going on. So what we're trying to show you with this example is you need to start reading between the lines. Yes, calculating the variances, or not variances, apologies, that's management accounting. Calculating the ratios here are important, but you have to be able to tell a story as well. So it's linking the calculations here, linking the output that you get to tell a story. And that story will be helped based on the narrative information in the question and also based on you just looking at the financial statements and looking at the key trends. The movement in assets, the movement in cash flow and overdraft, the movement in debt, the movement in equity, and getting an idea where profitability, both revenue and costs are going. Which one is growing quicker than the other? Now that takes time, right? That's a skill set in itself, but over the next couple of weeks with tutorial questions and with the question packs that you'll get practice at that, right? So first protocol is knowing your ratios and making sure you're comfortable with what each of them mean. And we'll give you a chance in the webinar next week to ask questions if you're unsure. And once you're happy with the calculation of the ratios, then it's a matter of going off and interpreting and telling a story, figuring out what the problem is in a company and coming up with recommendations of what the company needs to do to improve performance. Right? So this extra recording for week 6 looked at finishing profitability, then we looked at efficiency, liquidity and gearing. Teeing up then for week 7, we're going to look at the investment ratios. So if you get a chance, you might want to look ahead and see can you do some of those calculations before we do them in the live webinar next week. As well as that, we're going to look at the continuous assessment. So please do look at that in advance of next week's live webinar. Thank you very much.